we always talk about if as soon as you get that renewal offer from your bank, especially if you're listening to this and you're one of those 60% coming up, like go back and renegotiate with them. If you can't qualify to move it, or for whatever reason, maybe you changed jobs or you went from salaried to self-employed, whatever the reason is, and you don't have the option to move, you could still renegotiate and push back. They're sending you just that renewal offer, and they know that most people are just signing it back, because that's what we're just programmed to do as Canadians, is just not push back and just sign on the dotted line and move on. That's not okay. And the banks know that when OSFI says and comes back with, oh no, we're going to leave it as is, they know that it's going to be harder for people to move. And so they can offer crappier rates and build more of a margin in there for profitability. And to, both of our point, the lack of competition breeds that, and the less options that consumers have, the higher the rates that we're gonna have and continue to pay.
You're listening to the Ottawa Real Estate Podcast with your hosts, Paul Stevenson, David Warren, and Greg Campbell. Let's see what's going on in the world of real estate today.
Hello, everybody, and welcome back to the Ottawa Real Estate Podcast, your go-to source for all things real estate related in your nation's capital, our nation's capital, Ottawa. My name is Paul Stevenson. I'm one of your co-hosts, and I'm joined today by David Warren. How are you, David?
No Gregory Campbell.
No Gregory, no ChatGPT. That was just me waking up on a Tuesday,
A long weekend Tuesday. We're recording very late. This recording at the time that we usually release them at. So
yeah.
Those that are listening to these now, we apologize.
We're going to be getting harassed. People are going to be wondering what's going on. Actually, a few people asked me, like, is there an episode coming out yesterday? And I said, everything's going to be a day late, just like the garbage. We're there's a holiday, we're taking it. We're a day late. How was the weekend? What'd you get up to? Did I see you? No, I didn't. I didn't see you this weekend.
No. You were feeling under the weather, I think, Friday.
Today's the first day I'm actually feeling better, I would say.
Yeah. No, it was good weekends, was busy. I was telling producer Steve before coming on that we moved offices within the same building and floor. It's been chaotic over the past week moving stuff. It's always just like moving houses. It's like it surprises you how much crap you accumulate. So I was definitely spent most of my weekend here trying to set things up and get furniture together and all that sort of stuff. But
so you're gonna be on the ground floor? Will there actually be a walk-in then, like where the pharmacy was? Oh, okay.
No, just 2 doors down.
Great,
same size.
Okay, cool. That's awesome. Yeah, we celebrated Madden's 13th birthday over the weekend, which was pretty crazy. So my youngest, is now a teenager. So no more kids, only young adults in my house. It was pretty fun. We went to my brother's. We're doing renos, as everyone has heard on the last few episodes.
Mm-hmm.
We're adding a washroom, so everything's and we figured it'd be easier. So my brother hosted. It was great. Thank you to him for doing that. And it was just kind of great. It actually worked out really well. Easter weekend, we had everyone together, kind of multiple celebrations. So it was nice. It was nice. He got new cleats. That's kind of his birthday wish every year, is getting new soccer cleats. So it's kind of our ritual now. Every year we go get him new cleats. So it's fun.
Well, and he needs it. He keeps growing and loving soccer. So
for sure,
works.
For sure. And I think it happened after the show last week, but Jackson's team won in Game 7, which I don't think we talked about. So we're going to the finals, baby. Won in overtime. Wild game.
Yeah.
It was pretty wild. Down a goal, 2 minutes left, tied it up, won in overtime. Had no voice for 3 days. It was awesome. What's going on in real estate, David? Nobody cares about our personal lives.
I know. Yeah, we're just killing time here.
People. What's going on? What's going on in the real estate world? A lot of things happening, at least on the mortgage side.
Yeah, a lot of things happening. We've got, next Wednesday, we have the Bank of Canada announcements. Yeah. Yesterday, though, we had numbers out of the US come out for inflationary data, which did not help the Canadian bond market. The US government keeps printing money. They're adding about $1 trillion every 90 days now. That's a T, not a B. And they're literally printing money and causing inflation to go wild down there. So debt to GDP ratio in the US is at 131.5%, highest on record, much higher than after World War II, and no signs of cooling. So this caused the US 10-year Treasury bill to jack up. And yesterday we saw our bonds jump up about 12 basis points, which for those that have listened for a while, we've kind of talked about is that our fixed rates are tied to that. So over the last couple of weeks, we've been having the 5-year Canadian mortgage bond kind of coming down with our good numbers. And then that come down has been ruined by the US and it bounced back up. But so again, I think that we'll see what the Stats Canada numbers come out over this week prior to the Bank of Canada announcement. But I think that will play a lot into what the announcement comes out next week, being, again, I'm still on the hold methodology and nothing, and there's no announcement in May. So I think it'll be, again, based on that and how strong the US was and continues to be, that we can't drop our rates too early. So we'll see how that goes. But certainly all the numbers out of the manufacturing, personal spending, everything came out much higher than was expected in the US, which is no bueno.
Yeah, I'm not envious of anyone in those roles. Like Tiff Macklem has a challenging role currently. Everyone, even like we were talking about OSFI before we came on, and there's so many of those roles right now. OSFI being the Office of the Superintendent of Financial Institutions. There's so many of those jobs right now that have to make massive decisions that are literally impacting the whole country, that I'm really happy that all I have to do is advise people on mortgage options. Like we're impacting the economy in a different way, but I'm glad that it's not sitting on our shoulders. OSFI's had a couple things come up recently. They've been in the news for two things. One, we kind of touched on last week, which was the rejection of the suggestion or proposed removal of the stress test for uninsured renewals. So that would be anyone who bought a home that does not have an insured mortgage by CMHC, Sagen, or Canada Guarantee, that when it comes time for renewal, they would have to qualify at the contract rate. Let's say it's 5% plus 2%. So they'd have to qualify actually at 7%. I know you understand this, Dave. I'm just for the listeners. So they'd have to qualify at 7% to transfer that mortgage, even though their contract is going to be actually at 5%. So what this does is it actually limits a lot of people from maybe being able to transfer, because as we know, everything is higher, cost of living is higher, mortgage rates are higher. So, they might have qualified when they bought their house at 2.9% plus 2%, right? When they bought it. And now rates are up at, in the fives. So now they're qualifying at 4%, 4% higher than what they actually bought their home for 5 years ago. So it'll be interesting to see how this plays out over the next 2 to 3 years. As we know, there's a mass amount. I think it's 60% of mortgages in Canada are coming due in the next 2 years, 3 years. So it'll be interesting to see how that impacts people that have uninsured mortgages. The other interesting play on this is the fact that RBC just bought HSBC, which I know you talked about. And HSBC and RBC, I think between the two of them, have a massive share of the mortgage market. I know Scotia's up there. There's obviously the major banks all kind of have a good share of the pie. But RBC basically has a huge chunk, and having just bought HSBC, there's going to be a lot of those renewals that are within their book. So, if people aren't able to change, that's obviously going to be very beneficial for their book of business, but not so great for the consumer. So have you been talking to anyone that's heard of this or any challenging conversations yet?
No one it certainly comes up anytime there's a renewal. It's, I have to requalify again at that. I have a good track record. Like, how come my paying my mortgage last 10 years isn't sufficient enough? But what I thought was interesting with that decision from OSFI is that it was the Competition Bureau that brought it up and filed that complaint to OSFI, saying that this limits competition, and they identified that as not being good for the consumer and that it needs to be looked at and addressed. And somehow OSFI immediately just said, no, we're not doing that.
Yeah.
So clearly it was identified by the Competition Bureau. I know that Mortgage Professionals Canada had been lobbying for years to the federal government and to OSFI that these changes need to be made. When it's kind of interesting that it's still the case for an insured mortgage. So someone who, I get it's back and insured, but these are people that are putting as little as 5% down, plus the 4% insurance premium puts them actually at a 99% loan to value. So zero equity in that property. And they don't need to qualify with a stress test. But somebody who's putting more than 20% down initially, so who's shown a good track record of saving, to put that amount of money down. It doesn't matter even if it's $100,000 home and they're putting 20,000 down. It's it's a substantial chunk of money that these people are having to qualify under different guidelines, and that OSFI just immediately shut down Competition Bureau. I think that's the problem that and I know a lot of people share the same sentiment that we have a limited amount of competition in Canada, whether that be for banks for options there or for, we really only have five banks. We talk about the big six, but really it's five. And there's so many different areas in Canada of different industries where we lack competition and we lack options for competition, which leads to higher prices. And there's a reason why we have such higher prices for most goods. So I'm really surprised with that decision by OSFI to quickly chop that down. To your point, it'll be interesting to see if that changes over the next little bit as rates start coming down.
Yeah, one thing we hate in Canada is competition. It started with Canadian soccer, and now it's just transpired into everything. No, but I think the same thing. Like that, it seems like HSBC, I think, was the number seventh largest bank in Canada. They just got basically consumed by one of the top five. That seems to be everything. Like, a telecommunication company gets too big, well, they get bought by TELUS or Rogers, right? And like a grocery chain gets too big, well, they get bought by Independent or PC or whoever. So it's like you can't win in Canada. Like your goal as a competitive business is literally to get bought out by one of the conglomerates. So it is too bad for, I was gonna say crappy, what a terrible word to use. It sucks for the consumers because really we're at the end of the day, we're the one kind of footing that bill of the lack of competition. And this is a perfect example of that, where you're talking the biggest purchase people are ever going to make. And even in that, they're getting, in some cases, stuck where they have no option but to stay where they are, which is crazy to think about, in Canada, that you don't have that option to even consider alternatives because of rules, right? Because of regulations.
And I mean, the banks know that, and there's a reason why, we always talk about as soon as you get that renewal offer from your bank, especially if you're listening to this and you're one of those 60% coming up, like go back and renegotiate with them. If you can't qualify to move it, or for whatever reason, maybe you changed jobs or you went from salaried to self-employed, whatever the reason is, and you don't have the option to move, you could still renegotiate and push back. They're sending you just that renewal offer. And they know that most people are just signing it back because that's what we're just programmed to do as Canadians, is just not push back and just sign on the dotted line and move on. That's not okay. And the banks know that when OSFI says and comes back with, oh no, we're going to leave it as is, they know that it's going to be harder for people to move. And so they can offer crappier rates and build more of a margin in there for profitability. And to, both of our point, the lack of competition breeds that, and the less options that consumers have, the higher the rates that we're gonna have and continue to pay.
Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction. At Galtin Poirier Avocat Lawyers, we love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you. For an effortless client experience that opens doors, call us at 613-744-4488 or visit our website at galtinpoirierlaw.ca. Let's get to the heart of your deal.
Yeah, and there's two things here. Like, one, the banks are for-profit enterprises, right? Like, they're trying to make as much money as they can. And also on the other side of that, OSFI doesn't give a damn about the consumer. Like, they're not there to protect the consumer. They're there literally to make sure the banks don't become insolvent. Like, that's their job, is to literally oversee the bank's health, not the consumers. They don't care if it crushes the general public. As long as the banks are comfortable, they're good. The other thing OSFI was looking at is kind of a new mortgage stress test, in a way, where they want to limit banks from a qualifying standpoint, where the consumers in, I think, the overall book of business, correct me if I'm wrong here, Dave, my understanding is, and I don't think it's actually taken effect, this is proposed for 2025, that the borrowers cannot have more than 4.5 times their overall income in total mortgages. And my understanding is that includes your home, your cottage, your investment property. So people that, where this would really hurt people is people that currently own a home, maybe want to buy an investment property or buy, something to kind of build some equity in aside from their primary home. It's going to hurt them because they're looking at your overall portfolio. Now, I think when we were talking before we came on air, you were thinking it was on the bank side that their overall portfolio has to be less than maybe 4.5 times the total income of all of their applicants, but it's still kind of gray. Like, I'm still kind of, I was just reading this article over the weekend, so I'm still trying to kind of pinpoint all the specifics. What's your understanding of it currently?
Yeah, so it's effectively they're looking to limit a bank's overall portfolio exposure, that the loan to income ratio is limited on their uninsured mortgage loans, cannot be in excess of 4.5 times a borrower's income. So they're looking at this on a quarterly basis, and what they're worried about, I guess, is as rates come down, that people, qualify for larger loans and that sort of thing. It seems again like, the people that are going to suffer from this is the consumers. There's going to be less options for people, right now, anyways, even as rates come down and qualifying at 5.25, you know, like even a couple of years ago, which is what the Bank of Canada qualifying rate is. If it's either the higher of rate contract rate +2, or right now 5.25. So everyone's qualifying because rates are highs. They're qualifying at contract rate +2%. But as they come down, even at 5.25, you're still in that 4.5 to 5 times your income is the most of what you're qualifying for anyways. So anyways, they're just putting another stipulation on the banks of what they're able to loan out. And it's almost like they're really just strictly penalizing uninsured mortgages.
Yeah,
For
wild.
every change and everything that they're doing is focused solely on uninsured mortgages, which is also interesting because then it's pushing, okay, well, so everything has to be insured. But there's only 3 mortgage insurers out there, one of them being a Crown Corporation in CMHC. So it's kind of, which is a for-profit Crown Corporation. So it's interesting that it's like pushing almost the banks to back end insure and push borrowers into that insured bucket so that they can, just sell off that debt, which ironically right now the government is buying most of those bonds anyways, 50% of them as well.
Insane.
So I don't,
you know how insane
I don't really
that is?
understand. I don't really understand what the friggin' logic here is of, pushing borrowers to insured, which then pushes a big proportion of those insured mortgages to a Crown Corporation, a for-profit corporation in CMHC, where then is back end insuring the loans, packaging them together to sell off on the market, which is not going to foreign entities or hedge funds or anything like that buying up these. Right now, at 50% of those bonds are being bought by the Canadian government.
Who's backing the bond? Like, it's like you're
So
insuring the bond that you're buying. Like,
so
it's wild. It's wild. I
yeah,
don't think people fully understand it, but it's
and where does that money come from? Taxes. Canadians, like our tax dollars having to buy up all these bonds. So I really don't like uninsured mortgages is balance sheet lending for the banks. They have to have the deposits in their books to be able to lend at a certain ratio on any debt, and which came down. They actually OSFI brought that ratio down even over the last year and a half. So, and that's on their book. So I really don't, again, like you talked about before, they're publicly traded entities, the banks. Like, why not push that on them to manage their own books properly from a weighted average standpoint, as opposed to pushing it to, the insured side, where again, it's like Crown Corporation charging upwards of 4% premiums on the total loan amount.
Yeah.
So at 99% loan to values in some cases, for then those bonds to be purchased by the federal government. I just don't understand it.
It's a bizarre world. It doesn't, it's like, it's crazy. Like, when you actually think of the logic, like, what's the end goal here? Like, why are they buying so many of these bonds? It's a bit concerning, I would say. I don't want to say alarming, but it's very strange, and definitely we'll be keeping an eye on that, because that seems like there might be an underlying motive there. Not to jump to conclusions, we'll just see what happens. Interesting stat too.
Sorry, I was going to say that they're supposed to. They announced, Bank of Canada announced, I think last week or 2 weeks ago, that in 2025 they'll stop buying those bonds. When they were already supposed to, they had already announced that the government will stop buying those bonds by now. But that is so the quantitative easing, as they call it, has not ceased as it has supposed to.
Interesting stat. CMHC, when they first came around, when insured mortgages started, I think somewhere in the 40s. Let's just say 42% for fun, but somewhere in the 40s for sure. Over 40% of mortgages were insured. the most recent stat is only 18% of mortgages are insured in Canada. So that's a huge portion. I'm sure you've been like, I know you've been seeing it as well, but that's probably pretty accurate. I'd say 1 in 5 clients now are getting an insured mortgage. The flip side of that too is like both of us have been in the industry now over 10 years. So the majority of our clients are existing homeowners, existing clients that are selling, buying, or what have you. So a lot of them have over that 20% down payment. But typically those first-time home buyers, like people getting into the market, they're most of the time putting less than 20% unless they're getting, gifted funds or what have you. Because it is, I mean, most people aren't saving up $200,000 or $150,000 before they buy their first house, So yeah, I thought it was an interesting stat. And also all of these, as you said, all of these new regulations and proposed regulations and so on are for uninsured mortgages, which is the bulk of mortgages now in Canada. So it's not a small subsect of the market. It's the majority of the market, the vast majority of the market that is going to be impacted by these changes. So it is important people understand this. And if you're listening to this and you don't have an uninsured mortgages or an uninsured mortgage, tell someone who does, like maybe have them listen to this or at least research it on their own, because it is going to impact them on the next purchase, the renewal, all of these things. So fairly important to kind of stay up to date on these.
And they just compound on one another. Like it's not, this one change of the 4.5 times income ratio, it's not affecting one individual borrower or mom and pop that are renewing or buying, or first time home buyer buying at 20% down the road. But all of these changes will compound and do compound on one another to make it more expensive as the market keeps going. So as these changes come in, it's not a big jump. It's not like one big jump, like, good old 3% increase in carbon tax pricing like yesterday. Not a one-day hit like that. These are gradual, where on the back end, it's not kicked in. Like you don't, the average consumer won't notice or won't know that they're paying for these changes, but their rates will be, 10 basis points higher, 15 basis points higher, quarter point higher. They won't notice it, but on the back end, from a cost of funds perspective, the banks are going to, any of these changes that make it more costly for the bank, they're not eating that in, like you touched on, they're not taking away from their profit. They're passing that along to the consumer. And it's not just an upfront like fee difference. It's just caked into the rate. So they're not going to drop their rates as quickly, or they're going to keep a bigger spread or whatever it may be. But we do suffer as a society when all these changes keep compounding.
Yeah. No, great points. Last thing I wanted to touch on was the Bank of Canada has been doing some surveys just to see where things land in Canada. So they did 2 key surveys, also found, I'll read right from the article. Bank of Canada's 2 key surveys also found an overall improvement in sentiment in the first quarter among both consumers and businesses, despite the drag continued high interest rates are placing on the economy. So it says businesses see pricing behavior normalizing. So it says while demand remains weak, business leaders report a returning of sense of optimism, particularly when it comes to business conditions, sales outlooks, and employment intentions, according to the Q1 Business Outlook Survey, which is based on interviews with senior management from roughly 100 firms. It says firms hampered by reduced consumer spending over the past 12 months expect their sales growth to increase over the next 12 months. Among businesses anticipating that sales growth will improve in the next year, around half pointed to their expectation that interest rates will decline. So I think that's like common across the whole country. Everyone's just waiting for these rates to go down. They may not, like, I know we keep saying like, I think they will, but they may not. Like that is also a potential reality, so that's something that people need to be prepared for. Businesses as well, because a lot of businesses are leveraged through loans and lines of credit and so on. And that's costing those businesses more, right? So this is all kind of leads into this. The second part of that was that they said more people say they're planning to buy a home. So it says, as mentioned above, the findings also revealed an increase in the percentage of respondents saying that they are considering or planning to purchase a house or condo in the coming year. So nearly 15% versus roughly the 2023 average of roughly 13%. Not a big increase, but still. However, the Bank of Canada cautioned that this increase is likely driven in part by newcomers who typically have stronger buying intentions than other Canadians. In addition to high mortgage costs, consumers report that high home prices, limited supply, and considerable difficulty for renters to save up a down payment as key barriers to home ownership. That's pretty standard. I mean, the biggest barrier to entry, we always say, is down payment. Like that's really the biggest hindrance. Most people have the income to at least qualify for a purchase, but the down payment is always like, at least once a month, I'm getting how can I wrap my down payment into the mortgage? Or how can I have my down payment and legal costs covered by my mortgage? Or how can I get a line of credit to cover the cost? Like it's always, there's always people looking for that edge to get in without having to front the down payment. But I found that just an interesting survey. I didn't even know the Bank Canada did surveys, but the one with 100 businesses, I think it's good that they're doing that because it does give them kind of a pulse of the market potentially on the other side of the fence.
The positive sentiment by the general market is certainly interesting. I think that was probably also helpful and reflective in like Korea announced that February's home sales across Canada were up 20% over February 2023. So obviously people across the country are feeling much more optimistic about rates, about, where things are headed and wanting to jump in. And so, I thought that was kind of interesting. I mean, that's a big jump. Obviously, last year's numbers were substantially down. So being up over last year's isn't the hardest, but, kind of playing off that positive sentiment that you mentioned. And the kind of on the not a good segue at all, but there was, but CMHC did announce kind of on the building side, when we talk about demand though, is in Ottawa, at least, that we've seen a massive jump in rental condo construction. So a huge drop in builds for residential construction for home ownership, decline of roughly 20% there, like 19.5% from the record high seen in 2022. And we're now seeing in Ottawa, I'm trying to find the number here, that 63% of the total starts. So total starts means number of unit starts. So construction starting on units in 2023 were for rental condominium apartments. So 63% of units started being built in 2023 were for rental buildings compared to the average of 37% between 2018 and 2022. So this is, that's a pretty big jump between years, from 2018 through to 2022 being an average of 37 rental units being built of construction each year to then jumping to 63%, which, I mean, I see it, at least. I'm West Centertown. I see it all along Preston. I mean, the condos being built right now are, and I've talked about them before on previous episodes, are all rentals. And, seemingly when you look around the skyline of the cranes, that predominant portion of them are rentals as well. So I'll be curious to see how that plays out as we move forward as well, with housing starts being down and it being just rentals that are being built. How's that going to impact the overall resale market in Ottawa? I mean, if 63% of units being built right now are for rentals, because there are specific programs geared towards this, where it's, extremely cheap money, money for building rentals, and there's a big push there and a big fund created by CMHC for that. How that is going to impact the resale market over the next couple of years, because it takes, it's not as we, it's not something where you can instantly put a shovel in the ground. It takes quite a while of planning and permitting and drawings and everything. So I think you're on mute there, Paul.
I am on mute. I have a few questions for you on this. So number one, when these purpose-built rentals are built, is it typically the builders that are actually leasing them out, or do they sell it to then someone who's going to actually own and manage the property after the build?
No, the builders are holding on to them. So you look around, you've got, I'll use one along Preston, right behind the gallery. It's Tamarack building that building on Norman Street. It's Tamarack that is holding it.
So they'll manage the whole thing.
They'll just get a property manager into, which Tamarack has a property management division under the same family of companies, and they just rent it out. Beside my office right now, where the Travel Lodge on Carling is now a condo or a rental building. Two of them actually, and they have the signs that they just put up, and it's Sleepwell. That's just property managing, but they're holding them, that builder.
Yeah, so that's kind of, I guess, so it's two things. One, obviously, they probably feel, I know the condo market, Greg was mentioning that the prices are kind of stagnant. They haven't increased. There's not a huge, not a lot of people looking for condos currently, at least to buy. So I wonder if it's half that, they don't want to deal with the sales cycle of trying to liquidate 200 units, like there's always going to be people to rent. So do you think it's a matter of them wanting to just fill those buildings and recuperate some of their costs and like have it 100% occupied? Or do you think it's just a matter of the government incentives, or is it everything combined? Like, is it both of those things?
I think there's, we have vacancy is very low for rentals. So there's a high demand for that, especially as Ottawa keeps growing. And we talk about, immigration and newcomers, they're renting right out the gate. The programs that are out from CMHC for building purpose-built rentals and then rental rates increasing, like there's higher profitability over the long term for rentals and holding them long term. Where down the road, they can always, turn them into a condo and sell them like those units off if they chose to. But under those CMHC programs, they typically have to hold them for at least 10 years at a certain threshold of rates or if they're going under the affordable program.
That's with the 50-year no interest loans, right?
Correct. Yeah.
Nice.
Yeah.
Nice. All right. Should we slide into some mood boost, Dave?
Sure. Why not?
We're actually running longer than usual, which is surprising because we came on here.
We pulled that one together. We pulled that one together. We thought we were going to be 5 minutes.
Here we go. We'll start with 3 and we'll see how we do here. So number 1, did you hear about the kidnapping at the bakery? Don't worry. They woke up. Turns out they just wanted some bread. Oh, wow. Stephen jumped the gun. Okay, number 2. Why did the Scarecrow win an award? Not only was he outstanding in his field, but he also had some stiff competition. Wow. And number 3, I told my wife she should embrace her mistakes. She gave me a hug, then said, "There, I've embraced you." Ouch. Guess I set myself up for that one. These are...
That joke could have ended a lot earlier.
So bad. Okay, let's see. Last one. I have to end on a high note. Did you hear about the mathematician who's afraid of negative numbers? I think I said this one last week. He'll stop at nothing to avoid them, but, he needs to learn to be more positive. These are bad. These are bad today. 2 of them are from my calendar. 2 are from ChatGPT. We'll save ChatGPT for the intros. They're not much of joke writers, so
yeah,
we're safe for now. Another career saved, in comedian. Great. Well, thank you everyone for dealing with us and putting up with us for another episode. We typically release episodes every Tuesday at 10 a.m. And this one will be coming out likely later today or tomorrow. We're not sure. When it comes out, You'll get it. And thank you as always for tuning in. Make sure to subscribe. Leave a comment. Tell a friend. We love you. We'll see you next week.
Yes.
See ya.
Thanks for tuning in, everyone. We hope you enjoyed today's episode. Please remember to like, share, comment, and subscribe because we'd really like that.